This is a shipping container entering the port of Los Angeles. As it crosses the waterline, it is technically entering sovereign American territory. It is subject to U.S. federal law. It is inspected by Customs and Border Protection, and the waters around it are patrolled by the United States Coast Guard. But the global network moving that box, that doesn't belong to the United States. While the concrete slab it lands on might be public property, but the terminals, the actual money-making machines that process the world's trade, are increasingly private. And right now, one company has captured the operating rights to these terminals on every single inhabited continent on Earth. This is DP World. They are a state-owned enterprise of the government of Dubai. In just a few decades, they have gone from a local port operator to a logistical superpower, handling nearly 10% of the entire world container traffic. They generated over $20 billion in revenue last year, not by selling goods, but by charging rent on the choke points of the global economy. But their power doesn't just come from cranes and concrete, it comes from the contract. DP World specializes in concession agreements, massive ironclad legal treaties that grant them control over strategic national infrastructure for 30, 40, or even 50 years. While presidents and Congress operate on 2- and 4-year election cycles, DP World operates on half-century investment cycles. They sign deals that outlast administrations. So how did a company from a small emirate manage to buy the keys to the world's supply chain? Why do governments willingly sign away control of their coastlines for decades at a time? And perhaps most importantly, what happens when a sovereign nation decides they want their port back? To understand the sheer scale of this operation, you have to stop looking at political maps and start looking at trade routes. If you were to plot the journey of a pair of sneakers traveling from a factory in Ho Chi Minh City to a doorstep in Seattle, or a car part moving from Busan to Buenos Aires, the odds are statistically significant that at some point that cargo is handled by a DP World employee. The company currently operates over 80 marine and inland terminals across more than 40 countries. They have a physical presence on every continent except Antarctica. But to view DP World as just a port operator is a misunderstanding of their business model. They don't just want to be the gatekeeper at the dock, they want to own the entire path to the gate. This strategy was born in their home base of Dubai. In the late 1970s, Dubai was a modest trading hub. Today, the Jebel Ali port is the busiest port in the Middle East and one of the largest man-made harbors in the world. But the port itself is just the hardware. The software, the real engine of profit, is the free zone attached to it. DP World pioneered a model where the port is surrounded by a massive logistics park, a tax-free economic zone where thousands of companies can manufacture, assemble, and store goods without ever technically entering the country's customs territory. It is a state within a state, designed purely for frictionless commerce. It was this integration of port plus logistics that allowed them to expand so aggressively. When they pitch a government in Africa or South America, they aren't just offering to unload ships. They are offering to build an entire economic ecosystem. In 2024 alone, DP World handled roughly 88 million 20-foot shipping containers. However, unlike Maersk or MSC, which are publicly traded or family-owned shipping giants, DP World is different. It is wholly owned by the government of Dubai. This means it doesn't face the same quarterly pressure from shareholders that a standard corporation does. It allows them to play a much longer game. But to understand why a government would hand over such critical assets to a foreign state-owned enterprise, you have to look at the balance sheet. Building a modern container terminal is incredibly expensive. A single Super Post-Panamax crane, the kind needed to unload the world's largest ships, can cost upwards of $12 million. A terminal needs a dozen of them. Then you need to dredge the harbor, reinforce the quay wall to handle thousands of tons of pressure, and install millions of dollars in terminal operating software. For a developing nation, or even a cash-strapped developed one, that is billions of dollars in upfront capital expenditure. This is where the concession agreement comes in. In this model, the government acts like a landlord. They keep ownership of the dirt, but they sign a contract allowing a private operator like DP World to pave that dirt, install the cranes, and run the show. DP World pays for the construction and takes the risk. In exchange, they get the exclusive right to collect fees from every ship that docks. And here lies the catch. To make the math work, to recover that billion-dollar investment, these contracts typically run for 30, 40, or even 50 years. This creates a phenomenon known as infrastructure lock-in. Consider the political reality. A president's primary incentive is to cut a ribbon on a major infrastructure project before the next election. Signing a concession deal allows them to announce a billion-dollar modernization project without spending a cent of public money. It's a short-term political win, but the contract remains long after that president has left office. Take Ecuador, for example. For decades, the country relied on the river port of Guayaquil, but it was too shallow for modern megaships. The government knew they needed a deep water port to stay competitive, but the price tag was astronomical. So in 2016, they signed a deal with DP World to build the Bosoria deep water port from scratch. The Ecuadorian government got a state-of-the-art billion-dollar facility without draining their treasury, but in return, they granted DP World a 50-year concession. This means that until the year 2066, the most strategic deep water access point in Ecuador is effectively controlled by a company in Dubai. But what happens when a country wakes up 10 years later and decides they want out? What happens when a sovereign nation looks at that contract and simply tears it up? To answer that, we have to go to the Horn of Africa, specifically to Djibouti. Djibouti is a tiny nation with very few natural resources, but it possesses one asset that is more valuable than oil, and that is its location. It sits directly on the Bab el-Mandeb Strait, the narrow choke point connecting the Red Sea to the Indian Ocean. Roughly 30% of the world's shipping passes by its front door. Recognizing this potential, DP World secured a concession to build and operate the Doralé container terminal. It was the jewel of their African crown. For a decade, it printed money for both the company and the country. But in 2018, their relationship collapsed. The government of Djibouti claimed the original contract was corrupt and unfair. They didn't even ask to renegotiate. They simply nationalized the terminal. They seized control of the facility and kicked the DP World staff out. This was the nightmare scenario for the industry. If a government can just seize a terminal whenever they feel like it, the entire model of infrastructure lock-in falls apart. So DP World fought back. They took the case to the London Court of International Arbitration. The court overwhelmingly ruled in DP World's favor, declaring the seizure illegal and ordered Djibouti to restore the company's rights and pay hundreds of millions of dollars in damages. In a normal business dispute, the loser pays up. But Djibouti isn't the company, but a sovereign state. So they simply ignored the ruling. They kept the port, they kept the revenue, and they eventually brought in new partners. This exposes the fundamental limit of corporate power. DP World had the best lawyers and the backing of the international court system, but they did not have the physical ability to enforce it. While Djibouti took control over the terminal, but lost the trust of the industry for future projects. If Djibouti represents the failure of corporate power against a sovereign state, the United Kingdom represents the absolute triumph of it. In March 2022, a subsidiary of DP World known as P&O Ferries committed what many considered to be corporate suicide. They fired nearly 800 British seafarers over a Zoom call, replacing them with cheaper agency labor. The reaction was instantaneous, and the British public was furious. Politicians from every party called the move thuggery. By all conventional logic, DP World should have been exiled, but nothing happened. Even the fines were negligible because the British government ran the numbers and realized they had no choice. At the exact moment the scandal broke, the UK government was desperate to launch its free port policy, a post-Brexit strategy to boost trade. The primary investor committed to pouring another £1 billion into the flagship Thames Freeport was in fact DP World. But the leverage went deeper than money. It went to food security. London Gateway, a massive terminal built by DP World, handles roughly half of all deep-sea refrigerated imports coming into the UK. This created a terrifyingly simple equation for ministers in Whitehall. If you kick DP World out, or if you sanction them heavily enough that they pause operations, the supply chain breaks. The company had become too big to ban. They had successfully integrated themselves so deeply into the metabolic rate of the nation that removing them was no longer a political decision. It was a threat to national survival. Ultimately, the story of DP World isn't really about ships or cranes or even the billions of dollars that flow through them. It's about the invisible architecture of the modern world. We live in an era where we demand instant gratification. To achieve that level of efficiency, the global supply chain had to become a machine. And like any machine, it works best when it's standardized, automated, and controlled by a central operator. DP World has become that operator. They have provided the world with the efficiency it demands, but at the price of its sovereignty. So the next time you track a package and see that it has arrived at terminal, take a moment to wonder whose terminal it actually is. Thank you for watching, and see you in the next video.